Starting to see some animal spirits come into the flows here, some risk on. I would say it's crazy, bullish, but it's getting there. But here's some evidence. STY we're going to ignore. That's a heartbeat flow. That's going to come right out. But the Qs, you've got broad market there, financials, HYG, IVV. And you've even got some international here, which I'm going to get to in a minute. But what you don't see here, which is interesting, is USMV. You know how that thing has been on the leaderboard every week. It saw outflows because SPY, the S&P, is starting to outperform USMV, which arguably, again, is a bullish sign as low vol might start to weaken. Now, speaking of the international, that's the missing link in the flows all year. And I want to look at Europe. We look at Europe, it's actually saw some inflows. Now, that's not a lot, but for Europe it is, because look at the outflows this year. I mean, it is total bloodbath. You want to talk Halloween, just go to the year-to-date flows for Europe. And I want to look at that long term, too, if you look at how unusual it is to see Europe catch a bid. But if you look over the past, you can see the flow here. Look how lonely that flow is compared to what you normally see here. But if you look at the past month, Scarlet, Europe is actually starting to outperform the U.S. It's up 3.5%. U.S. is 2%. International has been the missing link in that equity flows. That's why fixed income has taken in more. So if international can get going, we could see things kind of snap back to normal.
Yeah, we'll see if it's fleeting or something more. All right, let's bring in Peter Tchir. He is head of macro strategy at Academy Securities, and of course, Sarah Ponczek, a cross-asset reporter for Bloomberg News. Peter, Eric just showed us the flows. I want to start with Europe. What's driving the inflows into European stocks? Is it Brexit relief or something more?
I think it's more. I really like the fact that Lagarde is taking over for the ECB. And I think really Draghi set the stage. He gave the rate cuts, he gave the QE. She comes into a clean slate, and she is going to focus on getting fiscal stimulus. I think Europe's ready for fiscal stimulus. That's going to be the growth. So I actually like overweight Europe.
So she's going to leverage her political skills to get those politicians.
Yes, I think she's really taking on a political role rather than a monetary policy role. I think France needs the stimulus. They don't really want to tell anyone. She's going to be at the vanguard of leading that charge. I think they get it.
All right, I want to talk about USMV, Sarah, because Eric mentioned it once again, low vol in the U.S. It's been a huge theme all year long. For a market that's lacked a lot of conviction, growth or value, cyclicals or defensive, this trade, the low vol trade, seems to have a lot of conviction behind it.
Right. The low volatility space has been an absolute juggernaut this year. If you just look at low volatility ETFs in aggregate, they've taken in near $23 billion. And to give you some perspective, that is a record for any year by a long shot, by a mile. In previous years, we hadn't even topped $10 billion. So to go above $20 billion, that's quite a lot. It's also more than double any of the other smart beta factor strategies. The one that comes in second place is dividends, and it's half of that. So that tells you something. But at the same time, all this popularity has really raised a lot of questions. Just earlier this week, we had Marko Kolanovic from JP Morgan come out, and he said that he believes that the bubble and low vol valuations probably occurred in August, and we're probably going to see that start to turn around, probably to hedge against that. He's recommending that people buy value.
Peter, you don't like, there's low vol and minimum vol. You're here to take out both of them at the same time. So what don't you like here?
So I turned negative on this at the start of September, and I don't like low vol because I think a lot of the stocks that are low volatility stocks are based on factors that are changing, right? That's dividend or a bond proxy. I think as people get more aggressive, they're going to want out of that. I also believe that some of the valuation metrics that made these low vol have been supported because of these inflows. I think if you start seeing outflows, there's not going to be the support for those. And min-vol to me is a little bit scary on the other side because it's someone trying to create a portfolio that has low volatility as a whole. When I look at USMV, the largest holding is Newmont Mining, right? A very volatile stock, but negatively correlated. That tends to have these, to me, correlation always blows up in hindsight. So it'll look great. So I think you're going to see significant underperformance both in an up or down market from those versus S&P. So if I was looking to hedge, I'd buy puts or something on those because you're getting cheap vol, and I think they're going to underperform.
All right, so not buying the low vol or min vol story here. Sarah, I want to bring up another story that you've been talking about, and something we hear a lot from investors. This idea that investors have suddenly focused on something that's old. This idea that companies need to be profitable. Who would have thought, right? Or at least a path to profitability. I suppose we can blame Uber, WeWork, and other former unicorns for this radical shift in thinking.
Right, surprise, surprise, profits matter once again, maybe more than potential growth prospects going forwards. But yes, it does seem like this all stemmed around the time that we were going through this WeWork mess. My colleague Luke Kawa wrote a story really early on referencing the quote-unquote WeWork flu, and we then saw that move move on into those software stocks. For example, if you look at IGV, that's the iShares Expanded Tech Software Sector ETF. Since July, it's down 6.5%. Meanwhile, the broader market is putting in new record highs. And we've seen it happening throughout this earnings season as well. Take Twitter, for example, as you can see right here compared to Tesla, two very different stories. Twitter, on the one hand, they had pretty healthy user numbers, which is usually what people focus on. Profits missed and the stock fell 20%. Tesla was the opposite way around. We also saw it with Google as well this week. And it does make sense. If investors are getting more worried about this growth outlook, then you want to make sure that companies can actually turn a profit. But the question is if this will continue.
And Peter, how do you play this? I mean, if you believe in everything that was just said and you can see it playing out, how do you actually implement this?
I'm looking for growth stocks, but more of the cyclical. Something that's going to, if we get a turnaround in the economy, that's where you're going to get a little bit more bang for the buck. I like energy, some of the beaten down sectors. I do want to, and maybe even look at old retailers. If you take a look in the retail space, Barney's, the flagship store, the only person who could justify buying that was an internet company effectively. Now they're probably not going to be there, so maybe you'll see a resurgence of retailers, some value. So I look for the beaten down sectors to turn around.
And you're here to blow up another crowded trade. Just real quick in 20 seconds, TLT, long-dated Treasury ETFs are on fire this year. You think this is going to end badly also?
Yeah, I do not know what happened. All of a sudden, everyone believes yields can only go one way, and that's lower, after 4 years of convincing themselves otherwise. And TBT, which has been a disaster for a lot of people, which is a short, has had massive outflows. So fast money, slow money, everyone is chasing yields. I think it's wrong. I think the Treasury Department's going to issue long-dated bonds. We're going to get growth, and you're going to see yields back up, and the 10-year get well above 2% again.